the sell-off in US Treasuries caused yields to soar, leaving the ETF with the worst return. It has been a withering start for government debt so far in 2022, but the extent to which bonds have come under pressure to start the young year is, perhaps, best exemplified by the downturn in the exchange trade funds that offer exposure to fixed income. The popular benchmark iShares Core U.S. Aggregate Bond ETF AGG, minus 0.29%, which tracks a market-weighted index of treasuries, agency debt, mortgage-backed securities, and investment-grade corporates, is down 1.36% so far this week, which seems relatively mild until you consider the decline would amount to the steepest slump to start the first 5 sessions of a calendar for the ETF since it was launched nearly 2 decades ago. Sign up for our Market Watch newsletters here. The previous worst start to the year for the fund was 2009 when it fell 1.29% through the first 5 sessions, according to Dow Jones Market Data. AGG's weekly skid was shaping up to be its steepest since March of 2020 when it fell 1.6%. The drop for the ETF comes as the 10-year yield mubmost 0.2y rose to as high as 1.8% on Friday, adding to a roughly 24 basis point gain in the prior 4 trading session. Meanwhile, the 30-year yield mubmost 30y, which was up this week by 21 basis points as of Thursday, rose to just above 2.1% as trading in the Dow Jones Industrial Average DJIA, plus 0.05%, and the SP 500 SPX, minus 0.32% indexes were mixed on Friday. Bond yields rise as prices fall and vice versa. The recent rise in rates, which have weighed on ETFs like AGG, referring to the iShares ticker symbol, follows minutes from the Federal Reserve's December gathering that signaled the central bank's intention to take a more hawkish tack in monetary policy as it battles COVID-fueled inflation pressure. Fixed income investors are penciling in prospects for an interest rate increase by the Fed starting in March, when the central bank is on track to have fully wound down its monthly asset purchases. Fed officials in minutes also said that it might be necessary to increase the federal funds rate sooner or at a faster pace than participants had earlier anticipated. On top of that, San Francisco Fed President Mary Daly on Friday said she could imagine starting to shrink the balance sheet after 1 or 2 hikes. Her comments came a day after St. Louis Fed President James Bullard, a 2022 voter on the rate-setting Federal Open Market Committee, said the first rate increase could come as soon as March. Beyond AGG, the popular iShares 20-plus year Treasury Bond ETF TLT, minus 0.75% also was down sharply for the week, falling 3.9%. The weekly decline for TLT was set to be its sharpest fall since the 8th of January 2021.